We talk about the Japan reverse carry trade, but can you kind of simplify it? Like, what does that look like a little bit, just for the average person that isn't in this space all the time?
When they raise interest rates there, their bonds will become more attractive than US bonds. And you'll see a rotation out of US Treasuries. And this started to happen in August of 2024. We saw 13% down in the S&P in a single day. And that was because they were aggressively raising interest rates, and people that had money, borrowed from the Bank of Japan, they were taking that out of markets in order to be able to pay those loans off. So interest rates dropping tends to be a good, bullish environment for risk on assets. But as we've seen them raise interest rates, that is the counter argument. You're going to see people, restricting lending, people not moving with their money as much. The velocity of money is at the lowest point that it's ever been in recorded history. Right now, people are hoarding cash, and they are going to continue to have to raise interest rates, because if they don't, their money is going to be worth less and less, and it's going to cost too much to live there in Japan. The upper bound for where they've protected that exchange rate is around 160 yen to one US dollar. And every time we've been close to that, they've intervened, they've, raised interest rates or done what they've needed to do to strengthen their currency against the dollar. Or the Feds come out and lowered interest rates on our side, which strengthens their currency against our dollar. So, I'd expect that they probably will wait till the end of this month to raise interest rates, but there's a lot of conjecture out there that they are going to do that instead of waiting until June or later this year. So when that happens, all of those bonds will flood back here to the US, those treasuries. You know that this is coming because Berkshire Hathaway and the Fed both have added a substantial amount of yen to their balance sheet to be a lender when this scenario plays out. Because as that money flows back, it's going to be very difficult for the FX market to float all of that. XRP could play a role there for the exchange of those currencies and provide like a liquidity buffer for the FX market there in Japan, as dollars or euros, whatever currency is being traded back for the Japanese yen to be able to repay those loans. But in case, we've got people in position that are liquidity providers that will basically buy that debt. They will lend them the yen so that they can repay the Bank of Japan, and they'll take on that debt note here domestically. But all that leads to, repricing across markets. All that liquidity basically gets sucked out of markets, repaid. And when that happens, I think you'll see stocks, gold, won't matter really where your money is, somewhere between 50 and 30% down on what that is. It'll be interesting to watch. We got a lot of deflationary pressures coming in from the implementation of distributed ledger technology and blockchain and AI and all these things converging. And I think that they knew that when they implemented these technologies, they would see significant deflation. And the way that you would position yourself for that so that you didn't have a deflationary collapse would be you inflate everything beforehand to kind of make sure that it's not going to be as bad as it would have been. So it'll be interesting, to watch everything play